Assalamualaikum and greetings to all. Today, we are going to share about bankers acceptance. But before that, did you guys know what actually bankers acceptance is about? So, bankers acceptance refers to a short-term financial instrument that is typically used in international trade, especially for import and export transactions. It represents a promised future payment from a bank with a maturity date between 30 and 180 days. A bill of exchange will be drawn on a bank and it is payable to the order of the drawer for a specified amount. The key advantage of a banker's acceptance is that it is backed by a bank, which makes it a lower risk investment for the holder as the bank guarantees repayment. You must be wondering how bankers acceptance work, right? There are a few steps on how bankers acceptance work. Firstly, the importer and exporter must agree on the trade term. Next, the importer will request the bank's involvement to guarantee payment for the exporter. The bank will accept the obligation and the exporter will ship the goods. Then, the bank endorses the banker's acceptance, meaning it can be sold or traded to investor. The exporter can either hold onto the banker's acceptance until maturity or discount the banker's acceptance by selling it to receive cash immediately. The bank is obligated to pay the holder of the banker's acceptance the full face value of the instrument. Lastly, the importer repays the bank.
And today I will be presenting the key market players in the bankers acceptance market and their roles in ensuring its effectiveness. Let me give you a brief overview. Firstly, borrowers play a critical role. These include the buyers or importers and sellers or exporters who use bank acceptance as a trade financing instrument. Importers rely on bank acceptance to fund their purchases, while exporters use them as working capital before receiving payment from their customer. Bank acceptance are attractive due to their flexibility and competitive discount rates. Next, we have the accepting banks. These banks are central to the bank acceptance market as they are issued or accept bank acceptance. They provide credit risk guarantees, ensuring the face value of the bank's acceptance is recovered at maturity. In addition, they support the development of secondary markets, enabling investors to trade discounts bank acceptance. Investors are another important group. These include companies with excess liquidity, fund managers, and insurance firms. They view bank acceptance as a secure short-term investment tool. By purchasing bank acceptance at a discount and redeeming them at a full value upon maturity, investors earn a profit while contributing to market liquidity. Lastly, regulators like central bank ensure the market operates smoothly by aligning it with monetary policy goals and maintaining stability. Intermediaries such as brokers and dealers further enhance liquidity by facilitating secondary market transactions. In conclusion, all these participants work together to create a balanced and efficient financial ecosystem. Borrowers gain access to trade financing, bank manage credit risks, investors earn return, and regulators ensure market stability.
A banker's acceptance also has unique features that can benefit borrowers. The first feature is the bank guarantee, where a banker's acceptance is a promise made by the bank itself to pay the face value to the holder at maturity. Not only that, but the guarantee also helps reduce the risk for the buyer and ensures that payment is secured for the seller. In addition, banker's acceptance has a short maturity period, typically issued for a duration of 30 to 180 days. This makes it ideal for short-term financing needs in trade. Furthermore, it allows for the transfer of ownership to the third parties, providing the holder with the flexibility to sell the instrument in the secondary market. Banker's acceptance is also issued at a discount on its face value. This means that the holder of the banker's acceptance earns a return from the difference between the purchase price and the face value. If someone wants to engage in international trade, they can use a banker's acceptance. This is because banker's acceptance is very useful in international trade, as it ensures that both the buyer and the seller receive a secure payment guarantee through the involved bank. Lastly, banker's acceptance is a good investment option because the associated risk is very low, as it is backed by a bank, offering investors a safer and more stable return.
I will share about benefits of issuing a banker's acceptance. First, enhance creditworthiness. Banker's acceptance improve creditworthiness by leveraging the bank reputation rather than the issuing companies. This is especially helpful for businesses with low credit history of those in volatile industry. It reduces counterparty risk, build trust, and enable better terms with partners. Second, lower borrowing costs. Since the risk of default shift to the bank, bankers' acceptance often have lower interest rate compared to unsecured loan. This makes them a cost-effective way for businesses to raise capital while maintaining liquidity, especially in competitive markets. Third, improve liquidity. These instruments are highly liquid as they are traded in secondary market. For businesses, this means immediate access to funds, while investors benefit from low risk. Short-term investment option with reasonable return. Lastly, risk mitigation. Bankers' acceptance transfer default risk to the guaranteeing bank. This provides assurance to counterparties, which is particularly valuable in high-risk market or when dealing with new partners.
Benefits of investing in bankers' acceptance. Let's start with the first benefit, low risk. Bankers' acceptance is considered a low-risk investment because it is guaranteed by the issuing bank. This guarantee ensures the investor will receive their payment even if the borrower defaults. With the guarantee, bankers' acceptance is a safe and stable choice for investors who prioritize their security. Next, bankers' acceptance offer high liquidity. It means investors can sell their investment on the secondary market before the maturity date. A high liquidity makes it easier for investors to access cash quickly, which is particularly helpful for trade, financing, and international business activity. For investors, its flexibility ensures funds are readily available without risking value depreciation. Other benefits of bankers' acceptance is a short-term investment. With a maturity period of 30 to 180 days, it allows investors to avoid long-term commitments that makes it less exposed to market volatility or economic factors like inflation. For those looking for short-term investment option and better cash flow management, bankers' acceptance is a perfect choice. Lastly, bankers' acceptance offer more attractive returns compared to other short-term instruments like treasury bills or commercial paper. Banks provide slightly higher discount rates to attract investors, making bankers' acceptance a low-risk option with competitive return. This makes it an excellent choice for investors seeking better profit without taking on significant risks. For conclusion, bankers' acceptance is an essential financial instrument in the money market. It benefits businesses by providing quick and flexible in short-term financing, especially for trade operation. For investors, it offers low risk, high liquidity, and attractive return by bank guarantee. Its flexibility to be sold in the secondary market before maturity makes it ideal for short-term investment. Overall, bankers' acceptance is a reliable and profitable choice for both businesses and investors, playing a vital role in supporting the global financial system. I think that's all from us. Thank you for listening and bye.